You know you need to start investing in the stock market, but you are absolutely terrified of losing your money. That's okay. That happened to me. After this 10-minute video, you will be much more confident in investing in your very first stock. My name is Bojana. I am based in Chicago. I have been investing for the past 3 years. I have invested in 3 portfolios. I have so far invested $46,000, and I share my investing journey and how I invest on this channel. So if you're into that, please subscribe and keep watching. Let's start with why would you even invest in the stock market? There is saving, there is real estate, there are many other instruments for investing. Why would you invest in the stock? Over the past 100 years, the stock market has averaged 10% annual return. Now, yes, that is before inflation, and before taxes, right? So we are not counting that in, but it is still a high return compared to saving the money, right, in a savings account. With stock market investing, you also have a very low barrier for entry. You can invest $1 or $5, but you cannot invest into real estate with such small amounts. So stock market is very accessible to any person with any amount of money, even a very small amount of money. Now you might say, what about saving though? Isn't it just easier? It's less risk, and can't I just get rich by saving? Not exactly. Screenshot here, I'll show most savings accounts in the US at least yield the return you're getting on your savings is less than 1%. So in most cases, it's 0.5%. Some accounts, they're called high yield savings accounts or HYSA, they do offer higher yield. So for instance, I have 3 accounts. I have 3.5 on one, 3.8% on another one, and I think 3.5 on the third one. So yes, you can get more yield. You can get higher yield on some savings accounts. And yet, still, compared to investing, you will not get that much return. For instance, you hold $5,000 for 1 year for 12 months in different savings accounts. Let's say your bank offers 0.45% APY. You will get just $22 in yield by the end of the year. But let's say your HYSA pays 5%, which is kind of risky. Most HYSAs do not offer 5% anymore. 2 years ago, you could find 5% yield. Now it's closer to like 4 or 3.5 even. But let's say you find a HYSA that offers 5% and you put $5,000, and by the end of the year, you can get $250. And $250 is much better if you do have some sort of amount of money that you might need in the nearest 6 to 12 months, so within a year. I would recommend keeping it in a high yield savings account. It's much safer way to preserve the value of your money and get some return if you just keep it in a HYSA instead of investing it in the stock market. But at the same time, let's say you have more than 5,000, you have much more money, and you are ready to part with it for 10 years, 20 years, 30 years. You are ready to really invest it long term. If you want a higher return, like 10%, for instance, you need to invest in the stock market. Again, with the $5,000 example, if you put $5,000 for a year in S&P 500 index, for instance, that year the return is 10%, annual return is 10%. You will get, by the end of the year, you will get 500. But if you invest $5,000 a year for 30 years, you will have $822,000. Not $1 million, but still much more money, right? Than if you were just keeping it in a savings account with 3% return. That's exactly why people go for investing, because they expect higher return than in a savings account at a bank. So to sum it up, why would you even invest? If you want a higher return, you need to invest. You need to take a higher risk and invest in the stock market. Easy. Now, what key terms do you need to know before you buy a stock? First of all, a stock, what is it? It's a part ownership in a company, or just one company. If you want to invest in a mix of different companies, say you want to invest in Google, Amazon, NVIDIA, Tesla, in that case, you want to buy exchange traded fund, or ETF, most commonly known. Here's a good visualization of what an ETF is versus a stock. And investors like an ETF for diversification, which is the second term that you need to know. Diversification is basically allocating your overall investment amount, like let's say 10,000, between different assets to make sure that you're not putting all your money in one basket. There is a saying, don't keep all your eggs in one basket.
What?
And we're talking, obviously, in this video, not about eggs. We're talking about different investment assets. So with the diversification example, you would be putting, let's say $10,000, you would be putting 60%, 6,000 in stocks, and 40% in ETFs. Also, by the way, you need to know there are different types of ETFs, and I made a video about those different types, so you can watch it here. Another term you need to know is volatility. Volatility is how much and how often the price of an asset fluctuates, so a price of a stock or a price of an ETF. And here you can see NVIDIA and Tesla, two good examples. Tesla is more volatile than NVIDIA, as you can see here on the graph. And this graph is basically, when you go to Google Finance, a free website, you put the name of the stock in search and you see this quote, this is called a stock quote. You can see this graph. This graph indicates how often the stock price fluctuates. NVIDIA, it just grows. It goes up. It does go up and down, but not as rapid, not as rapid jumps and dips as Tesla. And also you need to know that the more volatile the stock, the more often you need to be prepared for losses. So you will be losing money on the stock more often, and I'll probably say you will be more nervous about holding this stock because, one day you can have return of $100 on it, next day you can have return of $500 on it, and the third day you will have a loss of $1,000 on it. So that's not ideal if you don't have high tolerance for risk. Index funds, I already mentioned S&P 500. An index is basically like a group of companies that has been already vetted and chosen by multiple different organizations. They have like barriers for entry into the index, like the amount of revenue that you need to have within a consistent period of time, the size of the company. It's prestigious to become a part of the index. It tells the market and investors that you are not like a startup, you are reliable. And so once you become a part of the index, you might expect more investors to buy your shares. So that's why companies want to be a part of the index. And for you as an investor, if a company is a part of a big index like S&P 500, Dow Jones, NASDAQ 100, that means this company has already been reviewed by some analysts, and they said that, yeah, this is a worthy investment. Also, I want to mention two biggest mistakes that you might make when you start investing. First mistake is waiting. You're waiting when the stock market dips and all the stocks are cheaper, so you can buy them cheaper, or you're just waiting because you're afraid, you don't know what you're doing, you don't know everything that there is to know about the stock market, and so on and so forth. That was me. I started investing at 29, and I waited and waited, and right now, probably the biggest regret of my life is not starting to invest earlier. Fair point, I did not have as much money to invest earlier before 29 years old. But, I started when I started, better late than never. But if you're waiting to start investing just because you want, the stocks to go cheaper so you can buy them at cheaper price, so basically you want to buy the dip. It is like an actual term, buy the dip, meaning you're waiting when the market goes down and you can buy stocks cheaper. It's really not recommended because here's a image I generated via ChatGPT actually. What if you wait for the dip and the dip comes and you buy at the dip, and then in a month, there is bigger dip? You can never know when there is going to be a bigger dip. And if you invest at the first dip, you're going to have a loss in the next month. So, there is really no point. Like, you can get lucky, but you never know when you can get lucky. So it's best not to wait and do DCA, dollar cost averaging, which is what I'm doing. And so far it has helped me rake in over $6,000 in return. Unrealized return yet, but still. Yeah, I don't wait, I buy regularly. And if you invest long-term, you don't want to have headaches, you don't want to analyze the market too much, do not wait to buy the dip. Buy every month. Second mistake, the worst mistake, panic selling. When the market was down in April, everything was in red. All stocks were red, all ETFs were red. I think my returns from 5,000 went to less than 1,000. Obviously, I was nervous, but did I sell? No. I invest long-term. If you're willing to invest long-term for retirement, for instance, you're 30 years old, you plan to retire at 60, then there is no point in selling during these short-term dips. If you have the privilege of time and if you can wait long enough, you will get your returns back. It is important to invest in high-quality assets so that you don't lose the money. Because, when there is a huge, really bad economic crisis, a lot of companies will not recover. You need to be aware of that. That's why you need to invest in high quality assets. But even if you do make a mistake of investing in a not a very good company, like not a very healthy stock financially, you can still, if you have that time, you can give the time to the company to recover, you can still rack really good returns in long term. And finally, so how do you start? You now know not to panic sell, not to wait for the dip. You know that it's better to invest and not save. How do you start? First of all, you will pick a broker. Here's the list of all the brokers that are currently recommended. I personally use Fidelity Interactive Brokers. When you're looking at the brokers, what you want to have is no account minimum, so no balance minimum, no fees or extra commissions. Those commissions should not be super high, and you should not be penalized for your trades, so please research that. I have made a very detailed video here that explains how to pick a broker, what brokers are there, so please give it a watch. It's much more detailed. And second, of course, once you have opened the account with the broker, you can buy a first stock or first ETF. If you're going for ETFs, you're not familiar with all the metrics, how to analyze stocks, which there are many, I will make a separate video on that. But if you are not ready yet, you can buy broad market or index ETFs, SPY, VOO, IBV are the one that I hold personally. QQQ is a tech-focused ETF because it replicates NASDAQ 100, which is 100 most prominent US tech companies. If you want to add bonds to your portfolio, loans that you give to a state, to a company, to your government, and within some time, they pay you back the money with a yield. So if you want to buy bonds via ETF, you can try a BIL, which is a short-term US government T-bill ETF. So bill is a short-term bond. Or you can buy, for instance, gold. Yeah, you can buy gold or silver or other metals or commodities through the stock market. You can consider GLD, IAU, or IAUM. I personally do not have GLD in my portfolios, but I have the other two, and they have been working out good so far. And finally, you know how to invest, you know what ETFs you will be picking, but how much do you need to invest? I say start with small amounts. I started with $100 investment. That's all I could afford at that time. And actually it was a good thing because it built that lack of fear long-term for me. I was comfortable investing bigger amounts because I was starting with smaller amounts. I got used to that. I sort of developed that habit of investing. And so that was a good move to start with small amounts. So $50, $100, even $10, come on, you can do that. And secondly, you can identify the exact amount, the calculation. I made a whole video on how to calculate how much you need to invest for retirement, if that's your goal here. Please watch it. It's very detailed, and I give you the link to how you can calculate all the formulas. I think this is it. If you're a first time investing in the stock market, all this should really give you the head start into investing. Please let me know if something wasn't clear. And also feel free to download my 2025 investing strategy. I will pin it in the comments somewhere below the video. But yeah, thank you for watching. Subscribe if this was useful. A new video is coming next week. I hope you start investing soon. Bye-bye.